In this video, I'm going to walk through a decision of dropping or retaining a segment as part of differential analysis. We're presented with a company that has three different product lines: dirt bikes, mountain bikes, and racing bikes. And we have the contribution format income statement presented and segmented by those three different product lines. And preparing according to our financial accounting rules, we have all our sales and costs allocated amongst those three different product lines. And it's obvious why they note here that management is concerned, because racing bikes appears to have a loss. However, our assumption is that if we get rid of racing bikes, not only will the sales disappear, which is a bad thing, but we'll save on all of those costs, which to this point far surpass our sales of $60,000 and would end up saving us money in the long run. However, we really need to dig through and determine if all of those costs, it is correct they would disappear if we get rid of racing bikes. I want to note there's a couple important points we read through here with our fixed cost. Depreciation of our special equipment. They tell us here that special equipment is used to produce racing bikes and it has no resale value and does not wear out. What that means is we can't use it for something else. It has no use, irrespective of whether we continue racing bikes or we discontinue. We're still left with that special equipment, so it's not going to be able to be avoided. Allocated common fixed expenses. They're simply allocated. It might be corporate headquarter costs, those types of things, CEO costs. It's simply allocated according to sales. If we get rid of any of one of these segments, that cost, that $12,000 is not going to disappear. It's just going to get reallocated amongst the other product lines, so that would not disappear. There's a couple important points. Ultimately, the decision we need to make is, what is the advantage or disadvantage if we discontinue the racing bikes? And to do that, the way to do that is to compare the loss contribution margin, which in this example, contribution margin is sales of $60,000 minus variable expenses of $33,000 or $27,000. We lose $27,000 that previously helped contribute to cover our fixed costs and then hopefully to earn a profit. We want to subtract from that or compare that to any fixed costs that can be avoided. And our opportunities here are potentially advertising, depreciation, salaries of product line managers, and allocated common fixed expenses. So let me have a little bit more room, and again, we're focused on racing bikes, and just segregate that decision making. Again, contribution margin loss, $27,000. Why do I show it as a negative? Because previously that was something positive for our company, and if we get rid of racing bikes, that's going to disappear. Compare that to the fixed costs avoided. Advertising, it's noted as traceable, as noted in Chapter 6. That means it's specific to that particular product line, and given no other information, it advertises specifically for racing bikes and would disappear if we get rid of racing bikes. So we can avoid that. Why is it shown as positive? Because if we get rid of racing bikes, that's that much less we have to spend, and we'll treat it like an inflow. Depreciation of the special equipment, we don't show that as an avoidable cost. No matter if we keep the product line or get rid of it, that equipment's still going to continue even if we don't find a use for it. Salaries of product line managers, $10,000. We do show that as an avoidable inflow if we get rid of it. Sorry, product line manager, but if we don't have racing bikes, we don't have to pay you. And again, the allocated common fixed expenses of $12,000, you don't see those as avoidable. As I mentioned before, common fixed expenses aren't related to one particular segment, they're related to the company as a whole. You get rid of one segment like racing bikes, that $12,000 is not going to disappear. It's just going to get reallocated amongst dirt bikes and mountain bikes. It might again include things like the corporate headquarters or the salary of the CEO. So again, contribution margin lost, outflow of $27,000. Fixed costs saved, $6,000 in the advertising plus $10,000 the salary of the product line manager means $16,000 of fixed costs would come back in because we're going to save that. Add that to the $27,000 loss of contribution margin, and that means we have a disadvantage of discontinuing racing bikes. The important thing here is easy to lose perspective of what the decision making is. If we get rid of racing bikes, we lose more in contribution margin than we save in fixed costs, which means we would take $11,000 of profit away from the company if we got rid of racing bikes. So we would want to keep racing bikes. Again, this would be an $11,000 disadvantage. Now, that answers the question. I will note that there used to be an additional part of this problem up until the last edition. And while that isn't within the Connect problem, if you've pulled my handout, you'll note it's still on there. In a face-to-face class, I still work through it. So again, it's something not required as part of the problem, but I think it's helpful to be able to see this, to understand a little bit more clearly an alternative way we could present the income statement to make it more obvious that racing bikes is profitable. So I'm going to start out, it's going to look very similar to the contribution format income statement, where I list the sales for racing bikes of $60,000 minus a contribution margin of $33,000. Again, gives me a contribution margin of $27,000. But instead of listing all the fixed costs lumped together, we're going to separate it into two different categories. Traceable, meaning I exist to support a particular segment, versus common. I support the whole entire company. Common cost, you get rid of any one segment. It doesn't affect the cost in total. So we're going to list any potential traceable fixed costs for racing bikes. Well, advertising already has the word traceable for that, so that's obvious to list the $6,000 for advertising. The special equipment was particular to the racing bikes. We had noted in an earlier comment, so we'll list the $8,000 for it. The salary of the product line manager, it's a manager specific to that particular product line, so we're also going to list the $10,000 for the product line manager. But again, the common fixed expenses is not traceable. It's going to go on our later common category. So our traceable fixed expenses for racing bike is the $6,000 advertising, $8,000 depreciation, $10,000, and salaries of product line managers are $24,000. I'm going to create a new calculation, and that's going to be contribution margin of $27,000 minus traceable fixed expenses of $24,000, and that's going to be called a segment margin. In this example, it's the product line segment margin because we're talking about a product line. Our product line segment margin, again, is $27,000 in contribution margin minus $24,000, and our traceable fixed expenses is $3,000. Now we see that as a positive number because our contribution margin exceeds our traceable fixed expenses. And the point again of why I did this is to show this more clearly shows that racing bikes, even though it's small, is contributing something positive to the company. So this is a better way to present it. Where do our common fixed expenses go? Well, in a segmented income statement like I'm covering in this example, we don't try to haphazardly allocate our common fixed expenses. We just list them in total for the company. And again, they add up to be $60,000 in total. And just to show you, if I listed mountain bikes, dirt bikes, listed those, again, it becomes more obvious what each individual segment or product line is adding to the company. And again, we don't try to allocate out our common fixed expenses. We just subtract that $60,000 from the product line segment of $92,000 for the company as a whole. And our net operating income still agrees with our contribution format income statement of $32,000. But again, the segmented income statement is an alternative way of presenting our information for decision making to make it more obvious in examples like this of which segments are adding value to the company.